Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 34, titled Comparing Exit Strategy Calculations with Final Calculations, using the Ellman Calculator to assist with our trading decisions. Now, when we use the strategy of covered call writing, or even put selling for that matter, it's important to understand the various calculations that we use for enhancing our trade results. Some of these may be in the course of our trade, indicating whether or not we should execute a particular trade. And the other might be where our status is at that point in time, looking at our overall or sometimes final calculations, depending on where we are in the contract. So what we're going to do is we're going to define two exit strategies. There are more. And then we're going to look at a hypothetical trade using both of these exit strategies to see how the calculations for exit strategies might differ from our final calculations after the last exit strategy is executed, looking at these trades in totality. So let's start with defining the term rolling down. And rolling down, that's where we close a contract that we initiated and then open another one in the same contract month at a lower strike. So that's rolling down. If we had sold the 50 call and then rolled down to a lower strike, we might roll down to the 45 call as an example. Now, a second exit strategy that we're going to have a look at is the mid-contract unwind exit strategy. MCU is referred to in my books and DVDs. Now, this is a situation where the price of the stock actually goes way up as opposed to rolling down where the price of the stock is declining. So what we do with the mid-contract unwind exit strategy is we close our entire covered call position. That means we buy back the option, the short call, and then sell the stock, long stock position. And when we do that, that leaves us with cash in our account. And we could use that cash to then enter a new covered call trade with a different underlying stock to assist in generating a second income stream. So in both cases, we're looking to generate additional income streams after entering our initial covered call trade. Let's set up a hypothetical example here. Let's say we buy 100 shares of a stock at $74. And then we sell the at-the-money 74 call for $2.50. Well, our initial time value return is 3.4%. 250 divided by 74 is 3.4%. That's how we structure the beginning of our trade. Now, if the price of the stock goes down, we have set up our 20%, 10% guideline thresholds. The beginning of the contract, it's 20%, and halfway through, we change that to 10%. So 20% of 250 would be 50 cents. Let's assume the price of the stock declines, and that threshold is met, and we buy to close the original option contract at 50 cents. And then let's assume now we roll down to the 70 strike, and that generates a premium of $2. So we generated $2.50 initially, a credit. We closed that position at 50 cents, a debit, and then we sold the 70 lower strike for $2, another credit. Now, what happens if the price of the stock accelerates significantly? What if it moves up to 78? Well, we're required to sell at 70, the roll down strike price. So what would it cost us to close that 78 strike? Well, in this hypothetical, it's going to cost us $8.20. $8 is intrinsic value, the amount that the 70 strike is lower than current market value of 78. And 20 cents would represent time value. Now, whether or not it pays to execute this mid-contract unwind exit strategy, well, it depends. Can we generate more, 1% more than the time value cost to close? Then it would make sense to do so, since we're only mid-contract. So if it cost us $8.20 to close, and the shares could be sold at 78 because we no longer have an option contract obligation, that means our shares are worth an additional $8 from that 70 strike. And we're spending $8.20 to close the call. So net, we have a time value cost to close of only 20 cents a share. Now, can we generate more than 1% more than that by expiration Friday? And then we also want to ask ourselves, what is our overall profit and loss at that point in time? So let's feed this information into the Unwind Now tab of the elite version of the Ellman Calculator. And the results come in the spreadsheet on the right side. And it tells us that, of course, 20 cents converts to $20 per contract. And that represents a cost to close, time value cost to close, of 0.29%, way less than 1%. The question we ask ourselves, is it possible to generate 1.29% or more by expiration Friday? And if we're midway through the contract, the answer frequently is yes, we can. And so it would make sense to execute the mid-contract unwind exit strategy under this scenario where we sold the 70, the strike that we rolled down to, and the stock was currently trading at 78. Now let's look at our overall profit and loss after executing the mid-contract unwind exit strategy. Where do we stand before we enter that next trade? Well, on the option side, if you recall, we generated $2.50. We bought that back for 50 cents and resold the lowest strike for $2. Then we spent $8.20 to close that $70 call. Net, we have a loss on the option side of $4.20. Now let's have a look at the stock side. Originally, we paid $74 for the stock, but we ultimately sold it at $78. So that left us a stock credit of $4 per share, which if you take that in connection with the $4.20 we lost on the option side, that gave us a net loss of 20 cents per share. Now, is it possible to generate significantly more than that with half the contract to go? And the answer is most likely yes. So that's the difference between looking at an exit strategy execution per se and then taking the trade in its totality at that point in time. By the next trade, most likely we will have turned a loss into a gain. Let's summarize. Position management is the third required skill for option selling. First is stock selection, second is option selection, then we move into position management or exit strategies. Now, exit strategies aren't luck, folks. They are the intersection of preparation and opportunity. And we must take advantage of every opportunity that comes our way. Understanding the mathematics behind these strategies will make us better investors. And finally, the Ellman Calculator will assist with all these trade decisions. It will do the heavy lifting when it comes to the math. For more information on covered call writing and put selling, visit our website store, thebluecollarinvestor.com/store, where we have online streaming DVD programs, ebooks, soft and hardcover books, calculators, trade planners, and much, much more to enhance our level of knowledge as it pertains to option selling. So that ends our BCI podcast number 34, comparing exit strategy calculations with final calculations, and we use the Ellman Calculator to assist us with our trading decisions. Folks, I hope you enjoyed this presentation, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.